First, let's get to those CPI numbers. Brian, I've been going through the numbers. Brian Cheung is with us. I've been going through the numbers. I believe that 6.2% is the highest year over year that we have seen, going back to 1990. And the components here have been really interesting as well. Give us the details and the highlights.
Yeah, well, as you mentioned, the big headline number, you would have to rewind to before I was born in December of 1990 to get a print that hot. Again, the number coming in at 0.9% on a month-over-month basis. In the month of October, that beat the street's estimates of 0.6%. Now, when you take a look at a year-over-year figure, that clocks in at 6.2%. Again, that's the benchmark number that we haven't seen since 1990. That was also above the street's estimates of 5.9%. But of course, you want to strip out some of those more volatile components like food and energy to see what the underlying cause of inflation was here. Of course, we do know that gasoline prices were high. So if you strip that out, though, you still get a pretty hot inflationary print, 0.6% on a month-over-month basis, 4.6% on a year-over-year basis. And when you take a look at some of the individual categories that were in that report, which again dropped about 30 minutes ago from the Bureau of Labor Statistics, you can see certain types of categories that are particularly hot in the month of October. Obviously, as I mentioned, 6.1% increase was the gasoline. Obviously, that hit the headline number, but when you strip it out, there are still other components as well, namely one of them being shelter. Shelter is something that went up by 0.5%. For those that are wondering, well, isn't that kind of a small increase? Consider that if you have increased rent or increased mortgage payments, that's going to be a more persistent inflationary pressure because you'll be paying that over a longer period of time. But also consider that used car and truck prices actually increased between September and October. Again, this was one of those arguments for Team Transitory. Those increases in used car and truck prices would actually decline in the months of August and September, but it seemed to tick back up in the month of October. We'll see if that remains a trend. And obviously, food at home is something that people feel in their pockets, especially those on the lower wage of the spectrum. That increased by 1%. All the major food categories did increase. So definitely want to pay attention to that as well. And then lastly, worth noting that sporting events increased by 8.3%. So the reopening trade does still appear to be in effect from the October CPI report. A few other things that got cheaper between September and October: Frankfurter's jewelry and smartphones. Things that got more expensive: sugar, outdoor equipment, and also postage services. So all in all, a hot inflationary print. We'll see if that trend remains and tests the Federal Reserve's transitory argument as we do get into the early innings of 2022.
All right, let's bring it to the Fed then, Brian Cheung. We're going to talk much more about this in a moment, by the way, with Matthew Losetti of Deutsche Bank. But as it pertains to the Fed, it's as we frequently talk about, the Fed pays more attention, gives more weight to the so-called PCE deflator. And it's my understanding that, among other things, it gives a lower weighting to that shelter component, which, as you said, is an important component here for people's real lives and for the overall inflation number. So what does the Fed do with this number?
Yeah, well, I think either way, what we knew is that headed into the months of October, November, December, these inflationary prints were going to remain high. And Federal Reserve officials made that change in tone a few months ago, because at the beginning of the year, everyone was saying, well, yes, we expect to see some COVID-related price pressures increase, especially as the surge of people wanting to demand goods and services came along with the reopening of a $20 trillion economy. But most of those Fed officials and economists were saying and hoping that that was going to abate by now, effectively, by the fall of 2021. But of course, that didn't happen, and these prints are going to remain hot. So as of late, you've heard Fed officials say, look, we still expect inflation to be transitory. It's just going to be transitory over a longer period of time. An explanation I'm not sure is going to settle well with the American people that are noticing these types of things at the store whenever they do go and buy goods and services. Now, again, that could still be transitory if it fades even as late as the middle of next year. But if it lasts longer than that, does that mean an unanchoring of inflation expectations for the Federal Reserve? That could likely be the more important component here. If inflation as measured by, let's say, for example, the New York Fed survey or market-based measures like the TIPS markets show inflation unanchoring over the next, let's say, 3 to 5 year period to somewhere that 2.5%, 3%, that could be something that spells trouble for the Fed. That might signal it might have to tighten policy faster and more aggressively than people thought.
And of course, there's also the whole question of why is the inflation happening? If it is a supply shock and not as much a demand shock, how much control does the Fed over that? we could continue talking about this, and we are going to in just a few moments with Matthew Lazzetti, but got to let you go now for now, Brian. We'll talk to you a bit later.